Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are starting off this week with the S&P 500 hitting a new record high once again, going into the all-important FOMC meeting tomorrow afternoon, which is meant to set the first interest rate cut that we've seen in quite a while, and kicking off the expectation of 3 rate cuts for 2025 and 3 more within the first half of 2026. So markets are in a very optimistic state as a result of the expectations of rate cuts. We've seen large cap growth stocks continue to outperform, with technology, utilities, communications leading the markets higher, while consumer staples and materials have largely lagging behind. We've seen the bond yields across the board move significantly lower here, particularly on the long end, which is quite favorable for equities because the concerns around the stability of the bond market has been something that has been on the back of equity investors. But the recent declines in the long-term bond yields provides a more uh, robust tailwind for equities as equities kind of reach these all-time highs. We've seen market breadth continue to improve. So overall, we're heading into a week where optimism is quite high. The economic calendar is relatively light, with the exception of some jobless claims, the Philly manufacturing survey, housing starts. Not a whole lot on the economic calendar, with the exception of the FOMC meeting interest rate decision tomorrow, which the decision itself, I think, largely is fairly set in stone, unless the Fed gives us a 50 basis point cut tomorrow, which the market is currently implying only a 5% chance of that happening. But unless the FOMC meeting results in a 50 basis point hike, I think things are going to be relatively smooth sailing for the FOMC meeting tomorrow. What's going to be more important is going to be any commentary that Chairman Powell provides in terms of expectations for rate cuts for the rest of 2025, as well as the dot plot, meaning what the governors of the FOMC have predicted in terms of rate cuts for the rest of 2025 and into 2026. That is going to be closely scrutinized with regards to expectations for next year. So if you look at the S&P 500, we continue to see this upward and to the right trajectory that has largely gone unchecked now for nearly 4 months now, where we've seen the S&P 500 rally nearly 35% from the April lows. And, that rally we've seen has not had any pullbacks or consolidation to really note of. And that does bring some risk of a pullback here. But overall, when we look at the S&P 500, you look at the NASDAQ 100, uh, everything is still very much in this kind of bullish trend. We have not seen any signs that this bullish trend is coming to an end, or that there are signs of exhaustion here. The Qs have started to show a little bit of exhaustion here to the upside, but very much, recently breaking out from that double top does signal another bullish indication for the equity markets. Even small caps have performed quite well here in this kind of market environment. We're seeing a little bit of catch up here from some of the smaller cap names over the past few weeks, past couple of months. We've seen small caps actually outperform large cap. So this has been a fairly constructive, a broad rally that we're seeing across the board. If you look at RSP equal weight S&P 500 index, also rallying nicely here, breaking out to new record highs it has lagged the market cap indices a little bit here in the last a couple of weeks, but we'll see if that can kind of continue in terms of the outperformance, or just rather just the participation across the board for the broad-based S&P 500 index, if that can continue as a result of the interest rate cut that we're expecting here for tomorrow. So looking at kind of the ideas here for the week, some of the ones that we want to pay attention to are are sectors that have sectors that are um, sensitive to interest rates or will benefit from lower interest rates. And banks are definitely one of the sectors that I think are worth paying attention to, because lower interest rates will stimulate loan growth for banks, and that is definitely something that a lot of investors within financials are looking for. The other thing that can potentially help banks in a lower interest rate environment is really with banks that have a commercial real estate exposure. Commercial real estate in the last few years have struggled quite a bit in this kind of higher interest rate environment. So a lower interest rate environment will be stimulating for that specific part of their loan book, and that is beneficial for some of the major banks. And Citigroup is an interesting one because Citigroup trades at a pretty substantial discount to its peers. It's actually trading below book value, versus the average major bank is probably trading around 1.3, 1.4 times book value. So we're talking about, a pretty substantial discount that it's trading at. Yet Citigroup's expected to grow substantially faster than its peers. The one thing that Citigroup lags behind in is profitability. Most of the major banks have net margins that are in the 25 to 26% range. Citigroup is around 17%. So for that reason, Citigroup should be trading at a discount to its peers, but right now it's trading at a 30% discount to its peers. And that's really where, Citigroup has made quite a bit of progress in the last couple of years with regards to profitability. And as they kind of shift towards, the transformation, if you will, that Citigroup has been on for the last few years, this is really where I could see some potential upside for Citigroup as they have shifted their business, you know, um, away from some of the loss leading or the loss making parts of their business, and they focus on kind of the parts that they're really good at with regards to investment banking, with regards to trading, and those are some of the things that the bank has been working on in terms of turning around. And I think that's really where the opportunity sits, especially since recently Citigroup, as you can see, has broken out away from this triple top here. This triple top around 95, $96 level here has just been broken out here to the upside. So after you have a long period of outperformance, you typically will see a period of consolidation or pullback. And then if you get a continuation of that trend, that's really what we're seeing here right now. So the timing looks quite strong here for adding some exposure here to a big bank like Citigroup, especially when you look at the fundamental backdrop of lower interest rates. That is potentially beneficial for stocks like Citigroup. So that's one I think is worth paying attention to. The other one I think is worth looking at right now is Elevance Health. We've seen healthcare, one of the worst performing sectors, um, starting to show a little bit of interest here. Now, this is one that we're watching because, like United Health, Elevance Health has really underperformed significantly this year. As you can see from the April highs, it was a $450 stock back in April that basically bottomed around 275. So it's lost nearly half of its value here in just the last few months. And there's some early signs that this downtrend has started to stabilize. You have this kind of bottoming formation that formed kind of at the middle of the summer between mid July and mid August. The stock finally broke out here above this $300 level here, and as recently since it broke out here above this $300 level, has been forming a bit of a base here. And the question is whether or not this base can solidify and then from that continue to move higher here. We haven't gotten there just yet, but we have seen some of the earliest signs of this move higher here. Now, Elevance trades basically in line with the industry from a valuation perspective. From a growth perspective, it is, just basically in line with the industry, slightly below average in terms of EPS growth, but slightly above average revenue growth. So, overall, in terms of growth expectations, Elevance very much in line with the industry. Where it does excel a little bit is in profitability. The insurance companies like Elevance and United Health, they historically operate on relatively thin margins. So the industry average is around 2%. Elevance is around 3%. So not much higher, but higher than the industry from a profitability perspective. So this is really where these health insurance companies like United Health and Elevance have had a really tough year. And the question is whether or not we're starting to get a bit of a turnaround here. And that's exactly what we're looking for. As long as it can hold the $300 level and trade sideways, this is really where we see the potential for that improvement here going forward. So this is one that we'll continue to monitor and see if we start to get that upside, because the upside potential here is huge compared to how much risk you would take. Because if this thing got down below 300, I would get out of the trade. So the risk that you're taking relative to the upside potential here is huge. And that's why I really like taking a look at Elevance Health right now in these type of market conditions. The next one I want to take a look at here is Gilead. If you look at Gilead, Gilead, has recently kind of pulled back here quite a bit here, and the pullback is really the opportunity, in my opinion. When you get a pullback here, this is really where the risk to reward also looks quite positive here. Gilead, trades basically in line with the industry with regards to valuations. It's trading at around 13 times forward earnings, but growth expectations for Gilead actually significantly outperform the industry. So EPS growth expected is around 25% versus 7% for the industry. Revenue growth is very much in line with the industry, around 3-4%. But Gilead not only is expected to grow earnings faster, it's actually more profitable than its peers. Net margins are 22% versus 16% for the industry. So the fact that it trades basically in line with the industry from a valuation perspective, but is expected to grow faster and is more profitable, is really where I think the fundamentals look attractive here for Gilead. And when we look at the technicals, that's really where also, from a timing perspective, this looks quite strong here, because the upside potential, is into the roughly 125 range, versus if this stock pulled back even just a few dollars, into the 110, 108 range, I would say the timing on this is probably wrong and I would get out. So you're risking $4 or so to the downside with, probably 12, $13 to the upside. So you're looking at about a 3-to-1 risk to reward ratio on something like this at the current levels, now that we've pulled back here to that trend line. So I think Gilead is also an interesting opportunity to take a look at. The next one I want to take a look at here is a smaller bank, Truist Financial. I've mentioned this here in previous weeks, but I think is worth paying attention to here again. As you can see, it just generated a buy signal here today, a trend following buy signal, very similar to Gilead from the perspective of what we're looking for are kind of pullbacks to this trend line as an opportunity to get long, where the risk to reward looks quite favorable for further upside. And Truist, just like Citigroup, is trading below book value. Again, the industry average is around 1.3, 1.4 times book value. So we're trading at a pretty substantial discount relative to its peers. And the one thing about Truist is that it actually is expected to grow revenues substantially faster than its peers. We're looking at about 17, 18% revenue growth that's expected versus about 5% for the industry. And more importantly, it is just as profitable as its peers. So the fact that it trades at around a 30% discount to its peers is really what makes this stock look so attractive. And then, most importantly, from a timing perspective, right now happens to be an optimal time to seek some bullish exposure because of the risk to reward ratio that we see right now on this recent pullback here from this 47 to $44 pullback here. That's really what presents the real opportunity to take advantage of some upside. So what we're really looking for are pullbacks, and then looking for that move higher here, pullbacks and that move higher. So we've gotten that pullback here, and now we're looking for that potential next move higher here on Truist Financial, especially when the fundamentals look quite strong. The next one I want to take a look at here is Prologis, which is the warehousing and logistics REIT. This one is an interesting one because, as you can see, this 110 level has been an important level here over the past few months here. The 110 level has really been historically a resistance level here for the past few months, and we recently just broke out here in mid-August, and now that 110 level has been supported multiple times as new support. And what we're looking for is, now that we've kind of broken out above 110, we're looking for further upside here into the 125 range here as well. Now, Prologis trades at a premium relative to its peers. It's trading at around 22 times forward earnings, but it's expected to grow top and bottom line significantly faster than its peers, and it's far more profitable than its peers. So yes, it trades at a higher valuation than its peers, but because it has superior growth and profitability, that valuation is justified. And from my perspective, I believe that there still very much can still be upside in this particular stock. And I think the timing on this, given the fact that we recently just broke out above that 110 level, is an interesting time to potentially add more upside exposure here for Prologis. The next one that I want to take a look at here is, and this is, I'm bringing this up because I think it's important for investors to understand kind of how we're thinking about this in terms of ideas, right? Because the goal of these sessions is not only to provide ideas to you, but also to help you understand, like, a framework for how you find the best possible opportunities in the market. And Alphabet is a good example of this, because we have established an interest in Alphabet as early as this pullback here. Basically, we identified kind of this bottoming formation, and when it broke out here and pulled back to the breakout level, that's when we looked at adding Alphabet to our bullish list. So that was trading around 164. The stock is now trading at 251 just a few months later. So we're talking about a stock that has taken a substantial run in a very short amount of time. And this is really where it's important to understand that you want to align both technicals and fundamentals, because Alphabet at this stage, from a fundamental perspective, I still think looks quite attractive. It's trading at around 23 times forward earnings, which is just in line with the industry, even though it's expected to grow basically in line with the industry, but it's far more profitable than the stocks in its industry. So the fact that it trades at a valuation that's effectively in line with the industry is really what presents the upside opportunity, because it's far more profitable. And I think the market has really, in the last few months, really caught up to that, because there was a lot of concern earlier this year with regards to whether or not Alphabet's business model with search ads was going to be disrupted by AI. And I think we've now seen that, one, that hasn't been the case. And more importantly, Alphabet is adapting to AI for their advertising business. And it seems like they're actually going to be a leader in that particular space for advertisers to insert their ads within AI. So this is in a much more richer, more engaging experience for both the user and for the advertiser. So, for those reasons, it seems like the market is finally kind of re-rating what Alphabet is trading at. It's trading at 22 times forward earnings, unlike most of the other AI companies trading at 30, 35, 40 times forward earnings. I think Alphabet still looks quite cheap at these levels, but we do have to remember that we have to look at technicals as well. And Alphabet just generated a counter trend sell signal. What that simply means is that at this very moment, there's a higher likelihood of at least a consolidation period ahead, if not a bit of a pullback here, given just how steep this move has been in such a short period of time. And that doesn't mean that we're not bullish on this particular stock. It just means that now is probably not the best time to add new long positions here for Alphabet. The stock has just had such a big run that from a timing perspective, it's perhaps better to wait for a little bit of a consolidation or pullback period before establishing new long positions here for Alphabet. So when we think about ideas and we think about trades, you really have to think about both, because a lot of times ideas come across your desk all day long, from news, from social media, from idea generation tools to your friend, your family. There's no limit as to where you get your ideas from, and they come at all different times. It doesn't mean that the day that you find out about an idea is the day that you should act on it. You really need to think about the idea, the conviction that you have behind the idea, and then also the timing behind that idea. And this is a big part of what we're trying to do here, is establish kind of a framework for how do you think about, an idea, and when do you actually pull the trigger on that specific idea. Okay. So let's take a look at a different one here. Let's look at Alpha. Let's look at Block, formerly Square, and this is a good one from a timing perspective, because we basically looked at this stock when it recently bottomed here, when it kind of formed this bottoming formation, and when it broke out here, that's when we started adding to this position, and the stock rallied very quickly here into the low 80s, and then ever since it broke out here above that low 80, broke out to that low 80 range, it's been sort of trading in this range between, call it 82 and 72 roughly. And right now we're at the bottom end of that range. And that's really where I think from a timing perspective looks quite favorable for adding a little bit of exposure here and seeing if this can kind of break out here above that $82 level. Because if it can break out above 82, that's really where this looks quite attractive here to the upside. Block is trading at only 13 times forward earnings. It grows faster and is more profitable than its peers, yet it trades at a valuation that's about half of what its peers are trading at. And for those reasons, that's why I really like Block here, and I think is worth paying attention to this particular stock. And the timing on it makes sense to add a bit of exposure here to Block and see if in the long run you get some upside opportunity here if it breaks out above that $82 level. And then lastly, I'll leave you with one more bullish idea here before we move on to some of our bearish ideas, and that's going to be Micron, which recently had a pretty nice run here in the last couple of weeks. And for those of you that have watched this show every single week, I've been talking about Micron as an alternative to NVIDIA. And Micron, like Alphabet, just recently generated also a bearish counter trend signal. And that simply just means that it's run so much in such a short period of time that there's a higher likelihood that you get at least a bit of a consolidation period, if not a bit of a pullback here before it can continue moving higher here. So while we still continue to like Micron for the long run, the short-term timing on it does bring some issues about adding new long positions. So this is one that, while we like, I think is one that we want to keep in our back pocket to potentially add to this position if it gets a little bit of a pullback here. And then on the flip side, if we're looking at some of our bearish opportunities, one of the ones that we're looking at right now is Spotify. Now, Spotify trades at 51 times forward earnings. So this is an incredibly expensive stock. Um, and just in the last couple of months, I've really started to turn a little bit lower here. The trend quality has deteriorated. It hasn't turned bearish quite yet, but as you can see, it's kind of trading. It's been consolidating, and the question is whether if it breaks higher or it breaks lower from this trading range. And we just don't have an answer yet. But if you look at the fundamentals here, Spotify trades at 51 times forward earnings. Yes, it's expected to grow earnings faster than its peers. It's expected to grow revenues a little bit faster than its peers, but it's not any more profitable than its peers. So does that justify a valuation that's more than double what its peers are trading at? The average stock in this particular industry is trading around 21 times forward earnings, but Spotify is trading at 51 times forward earnings. That's just hard to wrap your head around, those specific types of valuations. So for those reasons, we are, from my view, is that if it does break, my hunch is that it's going to likely break here to the downside. Especially as kind of growth for Spotify slows down a little bit. That's really kind of where I think the valuations are concerning with regards to where Spotify can potentially move. The next one I want to take a look at here is Caesars Entertainment. This is just a stock that has continued to struggle here for quite some time here. As you can see, this stock has been underperforming by quite a significant amount here over the last year. And Caesars trades at around 32 times forward earnings, which is about double what the industry is trading at. Yet it's not expected to grow revenues or EPS at all in the next couple of years, and it's not profitable. So when you combine zero growth and a company that's not profitable, trading at 32 times forward earnings, nearly double what the industry is trading at, that's really where I have concerns that Caesars is likely going to continue to underperform here in the future. And then the last one I'll leave you with here is Philip Morris. Philip Morris, traditionally tobacco, big, strong margins, returns cash to in the form of dividends to shareholders, has really struggled in the last couple of years. They've struggled with profitability here. This 175 level here, it broke out above that 170 level, struggled to kind of make any grounds above that level, finally broke down below that, reclaimed that as resistance now, was rejected, and I think there's potential a significant downside. You have a major support level here around 160, right? This is a major support level that has been holding for quite some time here. As you can see, this has been a major level since April. If it breaks below 160, that's really where things can get quite ugly. And where Philip Morris is really struggling here is not growth. Growth is actually looking fairly decent here, but its profitability is what Philip Morris is struggling with. Where the industry, averages around 32, 33% net margins, Philip Morris has struggled substantially on this front in the last couple of years, where net margins are now 21%, so well below the industry. And I think if you look at the chart setup here, you've got a lot of concerning chart features here. You can call it a bit of like a head and shoulders pattern here with the 161 level, with the 160 level as kind of your neckline. And if you do get that head and shoulders pattern to complete, and you get that breakdown here below the neckline, we're really headed towards the low 100s to the downside. And I think that's really where I have some concerns with regards to Philip Morris going forward in this type of market environment. So with that concludes kind of what we're looking at this particular market from a broader perspective, and then hopefully giving you some ideas to look at here for the week. And I would say more important than the ideas themselves is the process by which we look at these ideas that hopefully you can learn to replicate when when an idea comes across your desk from news, from social media, from someone else telling you, from a subscription service that you have, to just look at an idea from a technical and a fundamental perspective and make sure that you have alignment on both before you pull the trigger, because a lot of times you can find a compelling idea from a fundamental perspective, but it doesn't mean that the day you find out about that idea is the best day to go out there and buy that particular stock or sell that particular stock. So consider the technicals and timing, especially if you're trading options on these types of names. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.